The world has been in a bad shape since 2020. To begin with, we saw how the COVID-19 pandemic-related restrictions disrupted our day-to-day economic activity. Later, the Ukraine war disrupted global supply chains and shot up commodity prices. Now, the recent Middle East conflict has stoked geopolitical tensions to dangerous levels. The Red Sea, once a safe route for businesses to ship goods, has now become dangerous. For much of last year, recession fears have been building against a sharp rise in interest rates, with two G7 nations going into recession recently. Now, is the global economy as bad as it seems? How is India holding up amid all of these global uncertainties? Let's talk about this and also decode the latest India's Q3 GDP numbers that has created much buzz. We will look at the finer details of India's GDP to see how well we are actually doing. Let's begin. You're watching Informed Investor, initiated by ResearchAndRanking. What exactly is a recession? Well, simply put, recession is a period of decline in economic activity. Now, during a recession, the economy slows down, meaning there is less production, fewer jobs, lower wages. Now, this leads to a decrease in consumer spending and a decrease in business investments. As businesses experience low profits, they may cut back on their investments or lay off employees, leading to higher unemployment. Now, this in turn leads to further decrease in consumer spending, creating a vicious cycle. Now, do know that recessions are considered an unavoidable part of the business cycle that occurs in a nation's economy. Now, you might have heard that a recession is officially declared when there are 2 consecutive quarters of negative economic growth. And while that's true to some extent, there's actually more to it than just that. You see, declaring the recession isn't as straightforward as counting quarters of negative growth. Economists consider a range of factors to determine if the economy is in a recession. Now, sure, 2 quarters of negative growth is a big red flag, but they also look at things like employment numbers, industrial production, consumer spending, business investment, etc. Now, think of it like putting together pieces of a puzzle. Each piece represents a different aspect of the economy, and when you put them all together, you get a clearer picture of what's really going on. Now, if other economic indicators are still relatively strong, it might not be enough to officially declare a recession. America's government has ceded authority to declare a recession entirely to the National Bureau of Economic Research, a private non-profit research group. Now, this agency decides when the American economy is experiencing a recession. Now, that decision is made by a committee of 8 economists, and it is based on a variety of factors such as industrial production, retail sales, real personal income, employment, etc. In another example, Japan's Cabinet Office also uses multiple indicators including factory output, retail sales, employment, etc. So we see it isn't straightforward to determine if an economy is in a recession or not. However, 2 consecutive quarters of negative growth is called a technical recession. Now, let's take a closer look at what's been happening with 2 of the G7 economies that slipped into a technical recession, which are Japan and the UK. So Japan, once seen as a top contender in the global economy, has now fallen to 4th place, just below Germany. It recently entered a technical recession, meaning its economy shrank by 0.4% last quarter, marking 2 consecutive quarters of declining GDP, regardless of whether economists officially call it a recession or not. Now, Japan's facing a heap of economic challenges. A weak yen is driving up the cost of imports, which is bad news for Japanese consumers and companies that rely on foreign goods. Plus, Japan's population has been shrinking for 14 years straight, with last year reporting the steepest decline yet, and the median age is creeping up to 49.1 years. But here's the kicker. Japan's stock market hit a new high recently, surpassing its 1989 peak. Now, despite the economic challenges, strong earnings and a renewed focus on corporate governance are drawing in foreign investors like Warren Buffett, who's been piling funds into Japanese markets. Now, shifting over to the UK, it saw a worse than expected 0.3% decline in GDP between October and December, following a 0.1% drop in the previous 3 months. Now, this marks the first time the UK has slipped into recession since the first half of 2020. However, economists do believe that the recession will be short-lived, with GDP expected to bounce back from the start of 2024. But wait, it's not just Japan and the UK facing economic challenges. Another G7 nation, Germany's economy, also took a hit in Q3, and we are still waiting on the Q4 data. There's also widespread expectation that Germany might slip into a technical recession. Now, amidst all the economic turbulence, the United States seems to be holding its own. Economists are feeling pretty optimistic about the US economy, with the odds of a recession this year estimated at around 40%, lowest since January 2022. So what's keeping hopes high for the Americans? Well, it's the strength of the job market and robust spending. In fact, economists have also lifted their forecast for GDP growth, consumer spending, private investments, and government expenditures compared to just last month. Now let's see what the IMF has projected for global economies in 2024 and 2025. According to IMF projections, in 2024, the global economy is projected to grow 3.1%, down from 3.5% in 2023. While there's a slight uptick forecasted for 2025 with growth expected to rise to 3.6%, it's still below the historical average of 3.8% seen between 2000 and 2019. Now, when we look at advanced countries' economies, they're facing a tougher hit. Growth in these economies is projected to be just 1.5% in 2024, a decline from 1.6% in 2023, and significantly lower than the 2.6% growth seen in 2022. On the other hand, emerging market and developing economies are expected to maintain more stable growth, with a projected growth rate of 4.1% and a slight uptick to 4.2% in 2025. Now let's zoom in on India. Despite the global economic slowdown, India's growth trajectory remains robust. Growth in India is projected to stay strong at 6.5% in both 2024 and 2025. Now, what's noteworthy is that India is expected to be the fastest growing economy in both of these years. Now, you might see in the graph that the pace of the global economy is slowing down, but there is currently no possibility of it slipping into a full-fledged recession. In fact, economic growth has been stronger than anticipated in the second half of 2023, particularly in the US and several major developing economies. Additionally, inflation has been declining faster than expected, with recent monthly readings nearing the pre-pandemic average for both headline and core inflation. Now, these factors, along with resilient GDP growth, are contributing to a brighter outlook for 2024. Now, economists believe a soft landing is a possibility for the global economy this year. But despite these positive indicators, there are some significant risks looming over the global economy in 2024. Let's talk about this. Geopolitical tensions have emerged as the most critical risk facing the global economy. We've already witnessed the devastating impact of the Russia-Ukraine war on the global economy, and the situation in the Middle East remains precarious. Conflicts and wars not only disrupt global supply chains but also have inflationary effects. While oil prices are expected to decline this year, any escalation of the conflict in the Middle East could lead to an increase in oil prices. The year 2024 is set to be significant in terms of global democracy, with over 64 nations holding presidential or general elections, which accounts for 49% of the combined global population. Now, any political instability or any surprises could add to political uncertainties, which could affect economic stability. Chinese economic growth is expected to slow down this year, the slowest pace since 1990, excluding the COVID-19 era. This slowdown could have widespread ramifications, particularly for advanced and developing economies that rely heavily on trade with China. Now, while these risks remain present, the global economy could also witness positive surprises as well. If inflation falls faster than expected, it would likely lead to monetary easing and a boost to global economic growth. Overall, the global economy defied expectations in 2023, and it may do the same in 2024 also. On Thursday, India's Q3 fiscal year 24 GDP numbers were released, and this has caught a lot of attention. First off, the previous quarter GDP number, which is Q2, had received a lot of praise because they exceeded expectations, growing at 7.6%. Now, the rise in GDP growth was supported by government spending, robust performance in manufacturing, mining, and construction sectors. However, there were some challenges we faced in Q2. Private consumption growth remained weaker, growth in the agricultural sector stood at an 18-quarter low, growth in the services sector decelerated, external trade was also a drag on the GDP as imports grew at a much sharper pace than exports. Now, coming to Q3 fiscal year 24 data. In this quarter, India's GDP grew at a remarkable 8.4%. Now, this number also smashed forecast. For Q3 fiscal year 24, analysts and economists had actually expected a slower GDP growth of between 6% to 7%. The government has now upped the forecast for both Q1 fiscal year 24 and Q2 fiscal year 24. And for fiscal year 24 as a whole, it now estimates GDP to grow at 7.6%, surpassing the initial estimate of 7.3%. Now, with 7.6% growth estimate for fiscal year 24, India will remain the fastest growing major economy in the world. Now, before we talk about what lies behind the Q3 numbers, let us understand how GDP is calculated so we can explain things clearly. And if you're already aware of how the GDP is calculated, you can just switch to the next segment. So there are two main methods used to calculate GDP. One is the GVA method across 8 industries, which we will cover in the following sections, and second is the expenditure method. The expenditure method focuses on the spending side of the equation. It breaks down GDP into 4 key components, and each of these components tell a story about India's economy. First, we've got private consumption. That's the money spent by consumers like you and me. Think about stuff like buying cars, furniture, food, clothing, etc., or spending on education, healthcare, doctors, etc. Now, moving on, there's gross fixed capital formation or investments, which we call it I for short. Now, this covers spending by companies and governments and households on things like machinery, equipment, and even residential plots. Now, government consumption expenditure is all about the government's role. It includes the money spent by the central and state governments on various goods and services for current use in providing public services and maintaining government operations. Now, net exports is the difference between what a country exports and what it imports. In India's case, because we tend to import more than we export, this component often has a negative impact on GDP growth. So when you mix all of these elements together, you get the grand total of GDP. In simple terms, it's the sum of all the money spent on consumption, investments, government activities, and net exports in a year. In another method, which is GVA or gross value added, this quantifies the value of goods and services produced in an economy. In other words, it assesses the contribution of a specific sector or industry to the overall economy. It is also seen as a pure measure of economic growth, as a computation of GDP includes indirect taxes and excludes government subsidies. The GDP number from the two methods may not be an exact match, but the level of discrepancy should be minimal. Now let's look at the finer details of the Q3 GDP numbers to see how we are doing. Now, several factors such as the base effect, downward revisions to fiscal year 23 data, certain sector outperformance, and massive investments by the governments have contributed to GDP growth, touching 8.4% in Q3 fiscal year 24. Let's discuss this in detail. One major factor was the spending by the central government. This supported gross fixed capital formation, which is the investment component, to post a double-digit growth. This means government policies aimed at boosting economic growth, such as infrastructure spending, tax incentives, etc., have contributed to economic expansion. However, private final consumption expenditure continues to remain a pain point. Though it saw a uptick from 2.4% in Q2 to 3.5% in Q3, the growth is still muted below the pandemic average. Importantly, rural consumption continues to face challenges, and this is also reflected in the muted sales of companies in the FMCG segment. The remarkable growth in Q3 was also due to double-digit growth in the manufacturing sector, followed by a strong growth rate in the construction sector. Overall, the industrial sector growth grew at a 10.4% in the December quarter from 13% in the previous quarter. Now, the service sector growth also improved in the December quarter due to the festive season. Now, if you see on this chart, trade, hotels and transportation segment also got a boost from India hosting the 2023 Cricket ICC World Cup in October to November. Another reason behind the better than expected GDP growth in October to December 2023 is a favorable base effect, with the Q3 fiscal year 23 GDP growth rate being revised down to 4.3% from 4.5%. Now, this has also helped GDP in Q3 to notch a higher number. Now, though the growth rate unexpectedly rose to 8.4% in the December quarter, the overall GVA growth was 6.5%, down from 7.7% in July to September. As we explained above, GVA is computed by subtracting tax collections after adding subsidies from the GDP. When indirect tax collections are more than subsidy paid out, the GDP is greater than the GVA. So the divergence between GDP and gross value added growth was driven by a rise in net tax collections and a sharp decline in subsidy spending. Now, coming to the key takeaways. Overall, GDP growth remained robust, beating all estimates. However, there remains pockets of pain. Most of the growth we are seeing is in the form of spending by the central government, but our private consumption growth has remained muted. On the production side, the industrial and services sectors remain strong, but our agriculture sector has declined. Moreover, the downward revisions in the GDP data for fiscal year 23 and the boost from net taxes in the December quarter have lifted growth in the first 9 months of this year. Now, going forward, the most critical aspect to watch out for will be a broad-based improvement in consumption growth. And another critical aspect would be a meaningful improvement in private investments. And both these two components are actually interlinked. Now, why would businesses invest if consumption remains weak? So the sustainability of this investment growth significantly depends on the need to strengthen our consumption story. Now, another critical factor is the rural economic outlook, with the growth in the agriculture sector being subdued due to uneven monsoons. Now, while the GDP numbers look fantastic, there are finer details that do show you different stories. Nevertheless, according to the government estimates, the Indian economy will grow at 7.6% in fiscal year 24, beating IMF projections of just 6.5%, which will make India the fastest growing economy in the world. Having said that, this is me, Mulzana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.